James, welcome. How did the Harmony range fare in July?
July was a good month for the Harmony Fund range. We saw a return to form for global equity markets following a quieter negative period in May and June. But in July, central banks clarified their position somewhat on the risk of tapering of quantitative easing. Markets took some confidence from that, and in that environment, of the 8 funds in the Harmony range, all 8 were in positive territory in July. Returns ranging from about 1.5% up to 4% as a monthly total return net of all fees, and also over a 12-month period, all 8 again in positive territory. The greatest return, I think, for sterling growth, nearly 20%, 19.7%. Over that 12-month period, which is a great result, clearly helped, of course, by a degree of sterling weakness over that period.
Okay. As you say, markets up last month. I guess that's going to be one of the key drivers behind those returns. Is that fair to say?
Oh, certainly, yeah. It was an environment that rewarded risk-seeking assets. Generally speaking, there's one exception to that, which is emerging market equity, traditionally a higher risk reward asset class, actually underperforming global developed markets. And as they've done so pretty much consistently over the last 12 months, and now there's a 20% return differential between those markets over that period. It's as much as anything else, it's a valuation story, and the valuation was less attractive in emerging markets 12 months ago than developed markets, and we had actually expressed that view in the portfolio, so we've sort of done well out of that. But as you say, developed markets generally doing well. Both the global allocation in our portfolios and the regional allocation doing well. Within our fixed income allocation, our decision to be very lowly allocated to developed market sovereign debt has done very well, whereas allocation in investment grade credit outperformed those sovereign paper, high yield clearly outperforming even further, and then actually convertible debt was the best performing of the fixed income asset classes that we use in the Harmony Fund range over the period. So, as you sort of go up the risk spectrum, you're getting more reward in the month of July.
Interesting. There's 2 things I'll bring you back to there. Convertibles you've got, is it just global convertibles, or how are you kind of playing that?
We do use extensively global convertible debt, but we also use selectively Asian convertible debt for a particular purpose. The valuation story there is probably more attractive than global convertibles, and also the exposure you get Asian equity market beta through those holdings, and that's an exposure we want to have in some of the portfolios, and using convertibles gives us a nice risk adjusted way of getting that beta.
Absolutely. And then the second one would be property securities. Your view there?
We've been underweight compared to our strategic asset allocation property securities for quite some time. There's been a decent return differential between broad developed market equities and property securities. That continued actually in July. There was a decent degree of underperformance again over the month, so that decision has been vindicated. Again, that was very much a valuation argument. Last year, certainly in the first half of last year, property securities outperforming the broader market, and we couldn't see any obvious reason for that. We thought that section of the market was getting expensive, so we took that allocation down and invested elsewhere in the global equity market, and that has paid off again over July. Other things we're having in our portfolio at the moment, we've got a decent weight in cash still. In a month like July, where global bonds, even government bonds, although they had a pretty tepid month, they were in positive territory. So having cash was a drag on performance in that kind of environment. But what it does do, it brings with it dry powder. It's something we can put into the market if there is a period of weakness to gain exposure in risk assets. And also it is a volatility dampener. It is a protector of value in periods of market weakness as well.
Speaking about dry powder there, did you find any cause to maybe deploy any of that last month?
Well, I mean, in the previous podcast we spoke a lot about, as the market comes back, there are increasingly interesting opportunities to have a sort of second bite at the cherry, if you like. There was a number of different markets where it felt like we missed an opportunity slightly as the markets kept going. We didn't want to chase our tails and jump in as valuations became less attractive. We talked about things like emerging market debt, potentially emerging market equities. We haven't made moves in either of those yet. We still think there's going to be a better opportunity coming, particularly in emerging market equities. We also spoke about taking potentially sector views and being a bit more fine in terms of our allocation there as valuation opportunities arise. We've made a very small allocation to gold producers, gold mining stocks. These securities have been very aggressively marked down as the gold price has come off. Now, clearly there should be a geared relationship between the gold price and these gold producers, but we think that's become overdone and actually represents some value and value that's worth trying to extract for our clients. It comes with a lot of risk, though. It's not, and you have to look at trades in terms of risk and reward. They come hand in hand. So as a result of that high risk, we've taken a very small position to start off with. It's only a 1% position, which for us in terms of a position initiation is actually reasonably small, and that's done on that kind of scale with one eye on the amount of risk it brings to the portfolio.
Absolutely. Finally, James, we're going to look forward effectively. You in fact have spoken a lot about being underweight, say, sovereign debt. Equity markets still looking reasonable value. Effectively, what do you see going forward? Do you find cause to make any big changes?
Big changes, no, as of today. I think there are opportunities presenting themselves. Global emerging market equity is one that we're taking increasingly seriously, as that relative performance differential continues to widen. Even in months like July, where those assets did go up slightly, they went up far less than global developed markets. So there is, an increasing argument to rotate some of our holding into emerging markets. We haven't done much in the fixed income portion of the fund recently, and we continue to be confident that to be low duration, high in credit, and avoiding developed market government bonds wherever possible is the appropriate positioning to take. So I can't see us changing the fixed income component of the portfolio materially going forwards, but clearly we're going to be tilting the equity weights between styles, between regions, potentially between sectors, and also looking to take advantage of broad homogenous valuation opportunities should they arise.
James, excellent. Thank you very much.
Thanks, Richard.